Hi, this is Andy Filipiuk in Toronto for the week of October the 23rd. Last week there was an excellent article on Zero Hedge about Citibank's research into global capital flows. Now, this research is generally produced for pension funds, large institutions, etc., and as a result, the retail client very rarely sees it. I think one of the reasons is that it helps complicate the investment process, meaning it's much easier to sell a client on dividend yield, price earnings multiples, earnings growth, etc., than to try to explain the global flow of money. Now, this article talked about the ECB, the European Central Bank, having purchased $1.5 trillion of bonds, both sovereign debt and corporate bonds. And the question was, where did this money go? Well, they answered the question. Most of the money or the bonds was sold to the ECB by domestic institutions and banks and individual investors to a small extent. Now, the question is, where did the money from the sale of these bonds go? Their conclusion was that it flowed into domestic equity, foreign equity, and deposits. So when one thinks of this, an institution such as the ECB took $1.5 billion of assets off the market and freed up all this cash. Well, it's no surprise that equity markets would roar higher with suddenly this new amount, $1.5 trillion, looking for a home. And with the central banks now tightening, the Fed has stated they're going to reduce their balance sheet. The ECB's talked about cutting back on its purchases. The question is, what does this do to global capital flows? And the answer is nobody really knows. But the oomph that took the markets higher may be starting to wane and begin to work in reverse. So when it comes to valuing markets, it's not so much the valuations that count right now, it's what the central banks are doing, both with interest rates and with the size of their purchases and the size of their balance sheets. Thanks for watching.